Hey, welcome to The Explainer. If the stock market has always seemed kind of confusing or frankly a little intimidating, you've come to the right place. Today, we're going to break down the absolute essentials and give you the core knowledge you need to start thinking like a real investor.
All right, let's just jump right in with a question that honestly gets to the heart of why any of us even think about investing. Let's say you've got some money saved up. How long do you think it would take for that to double? 5 years? 10? Maybe 20?
Well, there's actually a really cool shortcut for this called the rule of 72. All you do is divide 72 by your annual interest rate. So, if your money is just sitting in a savings account, maybe earning 4%, you're looking at a full 18 years to double it. 18 years. But what if it was invested and earning, say, 12%? All of a sudden, that's only 6 years. That's 3 times faster. This little bit of math shows you exactly why investing is such a powerful tool for building your wealth.
So that leads to the obvious question, right? Why not just stick your money in a bank where it's safe? Well, the answer is all about making your money work for you through one of the most powerful forces in the financial world. And that force is called compounding. This is the very concept that made Warren Buffett a millionaire, mostly in his later years. It's like a snowball effect. At first, your returns might seem pretty small, almost unnoticeable. But over time, the money you've earned starts earning its own money. And that snowball just keeps rolling and getting bigger and bigger, turning a small investment into something really substantial.
And this quote, man, it just perfectly captures why that snowball effect is so important, especially right now. In a fast-growing economy, you have all these companies with just massive potential to expand. For someone investing for the long term, all that potential growth is basically fuel for your compounding snowball. It creates this incredible environment for building wealth over time.
Okay, let's take a step back and ask the most basic question of all. What even is a stock? It's so easy to get lost in all the numbers and charts on the screen, but at its heart, you're buying something very, very real.
You know what? Let's forget the stock market for a minute. Let's imagine you and I are starting a company from scratch. Let's say we need about 5 lakh rupees to get a small manufacturing business off the ground. So where does that money actually go?
Well, first up, we need a place to work, right? So maybe 50,000 of that goes towards rent.
Next, the big one, the machinery we need to actually make our product. Let's say that sets us back 2.5 lakh.
And the rest, that 2 lakh rupees, that's our operating cash. It's what we need for day-to-day stuff, like paying salaries and buying materials.
And this is the whole point. A share is nothing more than a tiny, single piece of ownership in this entire 5 lakh rupee business. When you buy a share of a company, you become a part owner of their actual factories, their equipment, their cash in the bank, all of it.
So what's a portfolio? It's simple. It's just your personal collection of all these different little pieces of businesses that you own. You might own a piece of a technology company, a little slice of a bank, and a sliver of a car manufacturer. That's your portfolio.
Okay, so where does all this buying and selling happen? Well, it takes place in a regulated, organized space that we call the stock market. In India, you've got 2 main players, the BSE and the NSE. And honestly, the best way to think about them is like 2 different vegetable markets in the same town. You can buy the exact same tomato at either market, but the price might be just a little bit different depending on who's buying and selling there that day. It's the same with stocks. A company's share can trade on both exchanges, sometimes at slightly different prices.
Now, all these companies in the market are kind of grouped together by size, which we call market capitalization. Think of it like this. Large caps, those are the established giants, the household names you already know. Mid caps are the up-and-comers, growing fast. And small caps, they're the newer, smaller companies that often have the most room to grow, but, they can also come with a bit more risk.
And you'll always hear people talking about the market like it's a zoo, using 2 specific animals. A bull market is when everyone's feeling confident and prices are going up. Think of a bull thrusting its horns upwards. And a bear market is the opposite. Everyone's scared, prices are falling, like a bear swiping down with its claws.
Look, knowing all these terms is great, but the most important part, the thing that really separates successful long-term investors from people who get burned, is your mindset.
You absolutely have to, understand the huge difference between investing and gambling. Investing is about analyzing a business, understanding how it makes money, and focusing on its long-term growth. You're an owner. Gambling, well, that's just chasing a quick buck based on a hot tip or a rumor. You're just placing a bet and hoping for the best.
And this is such a key lesson. That price flashing on your screen every second of the day, That's just the market's mood. It's driven by fear, greed, and short-term news. A smart investor learns to see past that daily noise and focuses on what the company is actually worth for the long haul. So here's your mental checklist, kind of like your 4 golden rules. Number 1, know yourself. How much risk are you comfortable with? 2, diversify. Don't put all your eggs in one basket. 3, think long-term. This is a marathon, not a sprint. And finally, number 4, do your homework. You're buying a piece of a business, so make sure you actually understand.
And please, remember this golden rule for your own financial safety. It's super important. Never invest money you might need soon. The market will go up and down. By only investing what you can comfortably set aside for a long time, you give yourself peace of mind and the ability to ride out any bumps along the way.
All right, let's pull all of this together. We've talked about the why, the what, and the how of investing. But now, let's talk about the most important piece of the puzzle, your path forward from here.
You know, the biggest step in this whole journey? You've already taken it. Seriously, just by understanding these core ideas, compounding, owning a piece of a business, having the right mindset, you've already separated yourself from the crowd. You're now equipped to look at the market with intelligence, not just hope.
So I'll just leave you with this final thought. You now have the framework to think like a business owner, not a gambler. The foundation has been laid. So the only question left is, with this new way of looking at things, what's your first informed move going to be?